I'm tempted to introduce him.
Is he having trouble with the sign-in?
No, he hasn't contacted me.
Thanks, Eric.
Yeah.
Well, while we're waiting for him to join, yeah, maybe we should just start with an intro in the interest of time. What do you say, Bob?
I think so too. I guess I'll start because we are fortunate enough today to have a few guests on besides our clients. I thought I'd give just a couple of quick introductory comments about what Markets Policy Partners is. John Fagan and Brendan Walsh are the co-founders of it. Markets Policy Partners provides commentary on government policy and financial markets to readership that's comprised of professional investors and policymakers in the executive branch and Congress. John Fagan ran the markets desk at the Department of Treasury from 2014 to 2018, reporting to Secretaries Liu and Mnuchin, and decided to lift his service out of Treasury when demand for his work spread beyond the US Treasury and the White House, where his distribution was limited to. Prior to heading the markets operations, John and Brendan worked together at Discovery Capital Management as two of the early partners there and portfolio managers, which was at the time one of the largest macro hedge funds on Wall Street. Brendan, while they're focused on the financial sector, both banks and fintechs, and John focused on economics and macro. Michael Green, I'm thrilled to have on today, has been a student of markets for nearly 30 years. His proprietary work into the shift from actively managed portfolios and investment funds to systematic passive investment strategies has been presented to the Federal Reserve, the BIS, the IMF, and numerous other industry groups and associations. He joined Simplify in April of 21. And hold on, he is saying that he's having a hard time getting in. So let me pause this and try and figure out.
I sent him the link.
Okay.
I resent the link to him.
All right, terrific. Okay, so and he is before that he's been in the markets for a long time. He served as chief strategist and portfolio manager for Logica Capital Advisors, and prior to Logica, he managed macro strategies at Thiel Macro, investment firm that is Peter Thiel's. Prior to that, he founded Ice Farm Capital, and he founded the New York office of Kenyon Capital Partners, that's headquartered in Los Angeles, but he started the New York office. In addition to his work as a market theorist and portfolio manager, he's been noted for his work as a public speaker and financial media participant, and he went to Wharton and has a CFA. And has he been able to join us?
I should be in. Yep.
There he is.
All right.
How you doing, guys?
Thanks so much for joining today, Michael. I've just done the intro of you and us.
I caught the tail end of that, and I apologize. In today's technology dominant world, us dinosaurs got to stick together. For some reason, I could not get into the room until just a second ago. So thank you very much for hosting me, everyone.
Absolutely.
And I look forward to sharing some of the thoughts on particularly the dynamic of passive investing in markets, how it's influencing it. This is something that obviously I've spent a lot of time talking about and sharing with policymakers around the world. And so kind of why don't we launch in? I'll run through a couple of key slides and then we can open it up for lots of Q&A. All right. So I will share my screen. And I call this the greatest story ever sold. And the simplest way to think about this is there is no passive investing. We'll talk through the definitions of it. We'll understand how it is changing and affecting markets. And hopefully we'll have an opportunity to do something that I don't spend a lot of time discussing, which is, what are some of the alternatives? What are ways that we could begin to address this? Standard disclaimers apply. Anything I say is stupid and you really shouldn't pay very much attention to it. Okay, so what is a good example of when passive strategies become too large? Well, the one that I can obviously point to is the crash of the XIV in February of 2018, what's referred to colloquially as Volmageddon. This was an event that I had recognized was going to occur in advance, explained to actually the founder of the product in a public Q&A exactly what was going to happen to the product. And the simple reality was for XIV, you had created a dynamic where roughly 2/3 of the standard volume that was occurring in the volatility markets was simply tied to day-to-day execution of these ETFs in an event in which the S&P had a significant move, and that significant move could actually be predicated by the dynamics of the inverse VIX complex itself. This product had the potential to go to zero on what seemed like a very modest decline, right? So the analysis of the founders was that it would survive 1987. My analysis was that it would go to zero on a 4% decline in the S&P 500. It went to zero on a 3.9% decline. So we were both wrong, just some more wrong than others. Was fortunate to have profited from it, but this really set me down a path of trying to understand other areas where this type of growth of systematic passive index-based strategies where the strategy itself is perfectly transparent, and yet the flows associated with it are large enough that they're beginning to meaningfully influence the underlying market. It really set me down that path. And one of the first things that drew my attention to this, actually led to the XIV trade in part, was a paper written in 2016 by Lastek Peterson that revisited Bill Sharp's The Arithmetic of Active Management, which is kind of the Bible behind passive investing. The idea in passive investing is very simple. If you mimic the market, but you do so at lower fees, you're going to outperform the active investors in aggregate, right? Well, buried in that paper was an assumption. It's actually footnote 4, right? What is the definition of a passive investor? It's someone who always holds every security from the market, represented in the same manner of the market. An active investor is one who is not passive. So we've split the world very simply. If you hold every security and that's all that you ever do, then you're passive. But if you're not, then you're an active investor. The problem with this is, how does a passive investor get into the market? And the answer is either magic or they're not passive. Right. And so every single day, Vanguard, BlackRock, et cetera, receive inflows that they have to invest in the market. By definition, that means they can't be passive investors. They have to be active investors. Now, Lasse Peterson's paper examined this on the dynamics of index reconstitution. My contribution was to recognize that because of flows, they were in the market every single day. And so instead of saying, is there actually an impact, it became, I have to find where the impact is, right? And this becomes really critical when we realize the scale of the growth of passive investing. Most people focus on the dynamics of within mutual funds and ETFs, defining them as things like passive ETFs or passive mutual funds. There we've seen the overall trend explode in terms of share of mutual fund or ETF style assets. Passive is well over 50% at this point. But broadly speaking, people have historically thought about the passive share as just adding up Vanguard, BlackRock, et cetera. Unfortunately, that fails to capture things like futures. It fails to capture things like commingled investment trusts, which are unregulated mutual funds. It fails to capture separate accounts that mimic betas. It fails to capture total return swaps. And in fact, based on my prodding, a paper was just released in August of this past year, hitting the dynamics of passive ownership share. And Alex Chinko and Marco Salmon at Harvard Business School identified that using transaction data around index reconstitution under the strictest possible definition, the share of passive is about 38.7% as of 2020. And their math roughly agrees with mine that passive is gaining about 3% a year in terms of market share, which would put it somewhere north of 43, 44% as of today. This becomes a problem because, very similar to the analysis that I did on XIV and the inverse VIX complex, once you pass about 50% passive, the risk becomes increasingly high that markets exhibit discontinuous behavior. In other words, you can't actually transact in an orderly manner. That in turn makes hedging impossible, et cetera, changes the characteristics of all the derivative markets, and it really becomes a significant issue. The second factor that I would argue people have broadly failed to consider is the components of flow. So the analysis that was done by individuals like John Bogle, who highlighted himself that if everybody indexed, the only word you could use is chaos, catastrophe, the markets would fail. The analysis that was done in the 2010s around the share of markets that could be passive were built on static studies. And so they evaluated, well, what happens at 10% passive? What happens at 20% passive, 30% passive, et cetera? And they failed to consider the migration that allows that share to be possible. And so what we have today is a world in which more than 100% of the money that is coming into markets is actually passive. In other words, all active managers are experiencing outflows. On the flip side of that, the strategies now mean that less than 10% of trading that's happening in financial markets is fundamental in nature. So when we argue or we feel that the markets are disconnected from the fundamentals, that's empirically true, right? Less than 10% of the trading activity now involves somebody doing a cold hard calculus of what the prospects of the individual company are. When we start looking at the dynamics of theoretically what should be happening, how would we expect passive to impact the markets? And I'm going to go fast and we'll have lots of time for questions afterwards. One is that we would expect to see an increase in correlation between securities, right? If everybody is buying and selling everything together, then they should start increasingly behaving together. We should see an increase in valuation of securities, regardless of fundamentals, as passive share grows, because passive rewards momentum. So how does something get larger and larger in your purchasing basket in a passive framework? It gets higher and higher in valuation, for example. A third component is when everybody is transacting in a simple buy-sell framework, right? The classic risk-on, risk-off that we've experienced so much, you'll see an increase or a decrease, in elasticity. In other words, the changes in supply-demand at price. So what we're increasingly seeing is markets behave as if they are inelastic. In other words, a modest change in supply or demand results in a significant change in price. We would expect to see a further increase in market concentration as that momentum bias leads to the largest companies becoming larger. And finally, a reduced ability for new companies to become public. And there's wrinkles around all of these. And again, we're going to try to go through fairly quickly. One of the things that led me to my XIV trade was recognizing that the publicly available data on correlation, so this is going back to this point, was very limited and computationally intensive. And so if I looked at the black line, which is the history of implied correlation for the S&P 500, one, you'll notice that the data set only begins post-2008. Really, this entire data set was created to allow the pricing and proper trading of those inverse VIX ETFs, or the VIX complex in ETFs. You can extend this data set backwards using a mathematical trick called Kendall's tau, where instead of using a full correlation, I ask just a really simple question. Did two securities move in the same direction on the same day? If they continually do that, then they're going to end up being correlated. You can see that the yellow line roughly tracks the black line over the time period, not roughly, pretty darn closely. tracks the black line over the period in which the two overlap. And if we extend that back, we actually discover that we're experiencing rising correlation even through 2017. Now, what was unique about 2017 under this framework is that we had become so far extended below that a modest increase in correlation could cause the VIX to spike, creating those conditions. But there is this overall question of, well, is the thesis wrong if we're actually seeing falling correlation? And the answer was actually pretty shocking. What we were experiencing instead was a rise in the dynamics of what's called positive dealer gamma that was resulting in aggressive hedging of market positions by options dealers and suppressing volatility. If we looked at a constant volatility index, in other words, what happens to correlation when the S&P moves less than 25 basis points, you see that correlation is always low, almost by definition. If the S&P doesn't move, correlation means that roughly half the stocks are up, half the stocks are down. However, if we start looking at moves of 50 to 100 basis points, more normal levels of movement, what you could actually see is that trend was distinctly upwards. And in fact, if we extend this data series back using a constant volatility series, so in other words, what I've done is I've changed the level of the volatility of the S&P 500 so that it is constant over time, and then looked at the correlation, what we discover is that there's been an explosive spike in correlation across the indices, right? February 5th, 2018 was unique in one particular way. It was the very first time every single stock in the S&P 500 moved in the same direction. That didn't happen in 1987. It didn't happen at various other points in time. What was really crazy about that was that while that was the first time it happened, it then happened twice in December of 2018. It then happened 3 times in March 2020. And most recently, we've started to see this experience in 2022. In fact, the levels of co-movement and correlation when adjusted for levels of realized volatility are completely off the charts. Increase in valuation of securities regardless of fundamentals. There's a couple of different ways that this happens, but I'm going to walk you through the most important one, which is first we need to understand how active managers behave. And so this is proprietary research I did in 2018. I went out and I surveyed asset managers and I asked them a really simple question. You're an active manager, you have a portfolio where you have 5% cash, you receive an inflow or an outflow. What's your propensity to buy or sell based on valuations and that inflow or outflow? And so as you can see, as you would expect, your propensity to sell rises as valuations rise. Your propensity to buy falls as valuations rise. But what's really interesting about this is actually the intersection of the two occurring at almost exactly 50-50 at almost exactly the market's historical average valuation, right? Using a Shiller type PE. And the chart on the right explains why. When we run a simulation of this model, right, these marginal propensity curves, and have money flow in and out, we get a mean reverting market that centers around that distribution. In other words, when market participants discount, we get markets that discount. However, when we introduce passive players, and again, remember the rules of passive are super simple. They're active managers with the rule, did you give me cash? If so, then buy. Did you ask for cash? If so, then sell. In other words, they have 100% marginal propensity to buy or sell, right, on flows. When you introduce this player into the market, what it does is it shifts that 50-50 away from its historical mean reversion, and the market develops over time with rising valuations and an increased propensity to crash on outflows. You'll actually notice that the blue line is identical to what I showed before. The orange line here stops, and the reason it stops is, again, once we roughly cross 50%, I can't tell you where it's going to go, right? It becomes discontinuous. I can't actually solve this problem. That's not a good thing, by the way. That is incredibly stressful to me. And unfortunately, this matches the empirical data fairly well, right? Now, I think it's a coincidence that in 1974, 75, at all-time market valuation lows, we introduced the first index fund. But I don't think it's a coincidence that in the mid-1990s, as indexes began to rise rapidly, indexing began to rise rapidly as a strategy, that we began to see a structural increase in valuations, right? Now here I'm using a price to sales and I'm using the median in part because I want to reduce the distortions around profitability and I want to reduce the distortions around the extreme outliers. And you'll notice that that valuation is just structurally rising, right? Even the global financial crisis merely looks like a correction within it. You'll also notice that there isn't the dot-com cycle. And this is actually worth highlighting. The dot-com cycle was, in my analysis, a byproduct of indexing 1.0. Prior to 2004, 2005, most indices were market cap weighted. Now, most people think they're still market cap weighted. They're not, they're float weighted. And what this resulted in is in the mid 1990s, as indexing began to grow, it meant that they were actually buying twice as many shares of companies that had low float relative to their market cap, companies like Microsoft or Cisco and Dell. It tended to be associated with companies that had relatively recently gone public. That index distortion meant that the single best performing factor, which again, we didn't really use at that time, was insider ownership, right? And we constructed all sorts of narratives about this in the mid 1990s, right? The entrepreneur was still involved, the management team's interests were aligned with the shareholders, et cetera. And yet none of that has continued to be true. What we've actually seen is when the markets changed in 2004, 2005, that factor largely disappeared in relevance. And now we're basically left with lower distortion, but still distortions associated with passive. It effectively bought capacity. I'm going to skip this one. We can come back to it if we want. Reduced market elasticity, raising the risk of extraordinary price movements. Again, we're seeing this where volatility on fundamental events like earnings announcements is rising significantly. And the simple reason why is an increasing fraction of the market simply does not transact on that information. Nobody at Vanguard cares what Apple's earnings are. As a result, they do not supply liquidity if Apple's price spikes. They do not provide liquidity if Apple's price falls in response to that earnings. It's basically left to the shrinking pool of fundamental players to find their level. And the way I try to describe this to people is well captured in one of these academic papers that came out in 2021. The large increase in passive investing in the last 20 years has led to substantially more inelastic aggregate demand curves for individual stocks. When demand is more inelastic, small changes in market structure can have a large effect on price because investors are unwilling to change their positions. Perfect illustration of this is the meme stocks, the GameStops, et cetera, of the world. Vanguard was the largest holder of GameStop. Did it change its position when Ryan Cohen came in and bought a ton of shares? No, it could care less, right? What happened as the price went higher? Well, the next dollar that goes into Vanguard needs to buy more and more GameStop, right? And so these are the dynamics behind what's actually causing the meme stocks. It's this inelastic price behavior with a large investor experiencing inflows that says whatever the last price was is the right price. Another way I try to help people visualize it is think of the traditional market with active managers. Active managers have a sense of memory. If the price goes up 30% today, I tend to think that's expensive because I remember yesterday's price. And so markets can be characterized as moving around a mean, let's say a 200-day moving average or a 600-day moving average, kind of a 3-year rolling average. Unfortunately, when you introduce the passive players, the way to think of it is the markets behave as if they have a moving average memory of 1, right? Whatever happened last is the correct price. Increase in market concentration as momentum bias leads to the largest companies becoming larger. This is just a mechanical byproduct of the dynamic of momentum. But I do want to actually highlight that when this actually manifested itself in late 2019, as some style of index funds actually no longer qualified as diversified funds, right? So the S&P 500 growth, for example, became so concentrated that it no longer qualified under the 40 Act as a diversified fund. How did the SEC choose to respond to that? Well, they accommodated it. They said, oh, that's not your fault. That's simply the market doing what it's doing. Therefore, we're going to bend the rules, and you can continue to market this as a diversified fund, even though it doesn't qualify. These problems continue to get worse. If we look at the latest rally off of the June lows, for all the hoopla around meme stocks returning, et cetera, large cap gained market share, right? The largest participants, the largest contributions to that were companies like Apple, which crazily enough rose to within a few percentage points of their all-time high on that rally. We also see this dynamic hitting the bond market, right? Who were the largest buyers of negative yielding bonds? Well, this is obviously dated information, but the largest were actually the target date fund providers, right? It wasn't, European insurance companies trying to match asset liability frameworks. It was very simply a function of index replication. And again, if you think about the structure of the indices in bond markets, they are increasingly momentum oriented, right? Because the bond indices are market cap weighted, when an Austrian century bond goes from par at issue to 250, it becomes 2.5 times the weight within the index, right? That led to duration extension, and in my analysis, directly contributed to the horrific performance that we've seen in bond markets this year, where the durations had gotten the furthest out of hand they'd ever been. The last thing I would just hit on is this dynamic of reduced ability for new companies to become public. We're again seeing this play through where almost no IPOs are making it into the market, despite the fact that there was a giant flurry of venture investing. Now, we can introduce all sorts of narratives behind this, but one of the more interesting ones is the explosive growth of SPACs that actually allowed that to break for a couple of years. And this is a really good illustration, right? So again, we had a trend of fewer and fewer IPOs, and then SPACs exploded. Well, the reason why this occurred is because SPACs actually are an index arbitrage play. If we look within the Vanguard Total Market Index methodology, what are referred to as the CRSP indices, CRSP, the Center for Research and Security Prices, you'll notice that as of 2020, there was a unique characteristic associated with SPACs where they did not trade in the indices when they were blank check companies, but once they made the acquisition, if the acquisition was of sufficient size, they became eligible for inclusion in the indices in as few as 5 days. This meant that before the sponsors were able to get out on their 20-day trading, Vanguard was in there buying, right? And so these large acquisitions, if you look at the outright frauds like the Nikola's, for example, NKLA, the rolling the truck downhill, the largest holders are now Vanguard and other index providers, right? There's a interesting wrinkle on that one in particular with this Norwegian sovereign wealth fund that is experiencing guilt associated with their use of fossil fuels. But that is a perfect illustration of this type of dynamic. Okay, so what else are we seeing? Well, we're seeing a market that is increasingly negative skew in equities, positive skew in the VIX. We're seeing a market that is seeing its expectation in terms of return shifted to the right, but with larger left tails, right? So markets have a tendency to march upwards and then crash, march upwards and then crash. Of course, now we're marching upwards. This also has an implication in terms of how we think about portfolio construction, right? And so one of the core assumptions in finance that we deploy in portfolios is the idea of modern portfolio theory, which is that asset returns can be modeled as normally distributed around some level of expected return. Right? So over time, the expected return is flat, and then on a cyclical variation around that. The problem is, if my theories are correct, what we've actually done is create a market that has a curved structure to it. It's a convex surface. So instead of a flat expected return, what we actually have is an upward curve. Now, this creates a further headwind for active management because what we commonly refer to as alpha is actually just the intercept in a linear equation. Y equals mx plus b. The return of a portfolio is beta times the market return plus some factor alpha, right? This idiosyncratic dynamic that ostensibly represents manager skill. When you run this over time, what you discover is that a market that doesn't have a flat expected return or a stable expected return, but instead has a positively convex one because time is simply a proxy for passive share gain, creates an interesting challenge. That linear equation is forced to adapt to the slope of the surface by causing its intercepts or alphas to become increasingly negative. And this is exactly what we're seeing in the market, right? The theory is that alpha should be falling for the active segment. This is exactly what we're seeing in practice. Right now, the great irony, of course, is that this is being interpreted by academics or market participants as indicative of a market that is becoming more efficient. In other words, the problem is not with passive. The problem is that there's better and better active managers who are competing away at the alpha. That makes no sense given what we've seen in things like meme stocks or rising valuations, et cetera. These are not more efficient markets. These are less efficient markets that are being captured. And we're seeing this in everything ranging from short volatility strategies, which are experiencing decreased returns, to, as I talked about before, the structure of the returns themselves changing. The last point that I would make on this is that all of this is increasingly set on autopilot, right? So the rule structure around the Pension Protection Act in 2006 introduced what's called a qualified default investment alternative. And it changed the characteristics of 401k participation, for example, from what used to be referred to as opt-in to opt-out. What that means is if you get a job in America today, you basically are put into a 401k. That 401k defaults into a target date fund. That target date fund puts you into passive indices, both in bonds and equities, and asks only a single question: how old are you? So everything that I'm describing is increasingly just baked into the system. Active managers are being fired and replaced largely due to demographics. Their clients are simply old, right? The average age of a client at JP Morgan Asset Management, and I'm not picking on them in particular, is somewhere around 70 years old. The average age of a Vanguard client is around 39 years old, right? This is simply a demographic transition that's underway, where instead of the market being give or take 44% passive and that being a homogeneous distribution, what we're actually seeing is those over the age of 65 are only about 25% passive. Those under the age of 40 are between 90 and 95% passive. In other words, they don't even have in their lexicon a methodology for thinking about how to evaluate active managers. So this is the world that we inhabit. Those who can make you believe absurdities, that there are passive investors that can simply ride along without influencing markets, can ultimately make you commit atrocities. I'll pause there and I'll open it up for questions.
Thank you very much, Michael. Very sobering and a vivid warning for our listeners. Let's poll the participants and see if you want to have a question in. Please type it into the chat, and Bob can help facilitate. In the meantime, I can kick off the questions. It really is about, you talked about the tipping point at 50%. And obviously we're approaching that event horizon, but in terms of a precipitating factor in the markets, what do you see? Is it similar to the inverse VIX ETF in your mind, where it's a bad day in the markets turns into a cataclysmic day, aka 1987, or is it one of those? Or is it a kind of a situation where, because of the dynamics of passive investing, it takes maybe an extended bear market, something we haven't had in a very long time, to increase the levels of pain, withdrawals that eventually are the comeuppance of this strategy?
So I think the unfortunate dynamic is that it does look a lot like the XIV. There are differences, right? So repeating 1987, where the markets fall 25% roughly, is not really possible because we have circuit breakers, right? The question is, how do people respond to those circuit breakers? Does it lead to inflows where people say, hey, I'm really excited to take advantage of the opportunity created by the market down 10%? Or does it lead to people fleeing markets saying, oh my gosh, I have to protect what little wealth I have. Please sell me at the open the next day, right? Now, one of the most interesting comments that came out of the March 2020 events came from Vanguard. In the aftermath of it, they highlighted for the public that less than 1% of their investors had tried to sell. right? And that's, a statement as to the discipline of the bogleheads. Well, I react to that with a degree of horror, right? What if they tried to sell 2%? What would March 2020 look like? Or what if 3% or 5% had tried to sell? And the problem is that as Vanguard's clients age, they mechanically have to sell, right? So things like target date funds, et cetera, build in equity selling as you go into your retirement. Now, in a weird way, this saves us currently because we have a situation where the underlying dynamic is that the older generation is largely firing active managers. Those active managers are doing everything in their power to avoid distressed selling. On the flip side of that, money is flowing into passive vehicles and buying somewhat indiscriminately, right? That cushions these dynamics, but unfortunately we'll get to a point where the passive share is large enough that by definition they have to sell, right? And this is the other thing that people tend to underappreciate, is that selling is a function, the dollar value of selling is a function of asset prices, whereas inflows are a function of incomes. And so as we've seen asset prices rise relative to incomes, we're setting the stage for eventually we'll try to sell more than we can ultimately buy. Right. And in that scenario, then you do get a crash. And it manifests itself as a series. If you run a simulation of it, it manifests itself basically as a series of waterfall type events where just 10% today, 10% tomorrow, 10% the next day, punctuated by a 10% up day when somebody decides to try to buy, if that exceeds the selling, right? But ultimately, the markets work in reverse in a much more dangerous fashion on outflows than they do on the inflows.
We've got some questions in the chat here. First one is, how are active managers going to find alpha with these tailwinds on large caps? I guess the short answer, where they're struggling to do that.
So actually that's part of the point that I would make is that the underlying feature of the market is such that it can't actually generate, you can't generate alpha if this is correct. And that's, unfortunately what we're seeing in the markets is fewer and fewer managers generating alpha, fewer and fewer strategies generating alpha. And it's literally just built into the system as it's currently constructed. As human beings, we're drawn to a narrative, right? The sun moves across the sky because it's driven by a god in a golden chariot, right? We believe that for thousands of years. We want to construct narratives that say the reason we're seeing managers struggle is because the markets are becoming better over time, right? This idea of evolution somehow moving towards a better outcome, right? Well, that's just not what evolution does. Evolution exploits a scenario. We have regulators pushing money into passive vehicles. Perversely, that causes passive to outperform through the dynamics that I've shown, drawing money away from active managers, and a doom loop is created.
Just as a corollary to that, obviously, for the fund manager, if you asked a lot of hedge fund managers sort of behind the scenes, they would admit that levered beta is their solution.
Yep. Yeah. No. And by the way, that's exactly the correct solution if you're actually in this structure.
Yeah. Is there any other? How are you trying to position yourself in this? Is it a levered beta play, or is this too radioactive? You see the waterfall, the lazy river leading to the waterfall, or is this something that you've taken a different positioning on?
Well, in general, the way that I've argued that people should gain exposure is by using long-term call options that do not properly price the drift features that we're experiencing. Now, I'll be honest with you that on a short-term basis, I have been very much of the view that the markets are likely to retreat, and I've been wrong in the past several days. So my positioning from a professional standpoint is clearly not correct. I'm sitting here watching markets in the background, where the biggest component that I guess I would highlight for people is that what we have broadly seen is a rising US dollar reflecting distress beginning to emerge in the rest of the world. That has been correlated with falling US equity markets or falling global markets, clearly today is a break from that type of dynamic, right? So in just the simplest form, the way that I recommend people do this is a variant of the Chuck Prince dynamic. If the music's playing, you still got to dance, but just do so in a risk limited way, right? So if you're going to buy equities, buy call options. If you're going to run equity exposures, make sure that you're buying protection as well to reduce the incidence of negative skew, and accept the fact that you will generate lower returns as you do that.
Got it. Another question from the Q&A. Have you got a sense of the drivers on the client side to move to passive, i.e. cost versus ESG versus simplicity to comprehend? What is it?
Yeah.
Performance? Is it just the ease factor?
Yeah. So the single biggest driver, as you would expect in America, is avoidance of liability, right? And this was almost explicitly encoded with the DOL fiduciary rule, which was written by passive participants. Either that, or you can believe that it was written by a woman named Phyllis Borzoi, who was an English teacher from New York State. I am skeptical that legislation was actually, that regulatory framework was written by Phyllis, as brilliant as she might be in her analysis of Huckleberry Finn. The simple reality is that rule would have been an unbelievable epic disaster had it been fully deployed, because it set up criteria by which anyone offering a plan that did not exclusively put people into the lowest cost index funds exposed the sponsor to liability, not only for the excess fees that were potentially incurred in the 401k plan by offering higher cost choices, but also the underperformance, right? And so under that framework, there isn't an HR manager on the planet that is going to sit there and say, wow, I really understand that I'm exposing my company to massive amounts of liability, but I really believe in this active management thing. And so, we're gonna make sure that we have choice. Like, it just doesn't work that way, right? They're like, okay, fine. So everything goes Vanguard. I'll give you the extreme version of that. Simplify is a startup. We want to offer benefits to our employees. For our 401k plan, we have an outsourced 401k provider. That 401k provider has a contract with Vanguard wherein they guarantee minimum participation in order to secure access to even lower prices. And as a result, despite everything that I'm telling you, I have to put 10% of my retirement assets into a target date fund, even under the self-directed component, right? So you can't escape this stuff. Many brokerage firms, many large wealth management platforms have decided to adopt the spirit of the DOL fiduciary rule, defaulting their investors into things like passive or target date fund strategies for the very simple reason that they think this is the direction it's going and they want to minimize their liability. And the other absurd story that I tell people is that there's a cottage industry. And by the way, there's the first indications that this may be breaking, but there was a cottage industry of law firms going out and suing 401k plan sponsors under class action status, finding a few aggrieved former employees. And one of the most extreme examples is Fidelity forced to settle with its own employees for offering Fidelity funds in their 401k plan.
Well, actively managed. Unbelievable.
No, yes, but just the fact that they were Fidelity funds and were not necessarily the lowest cost choices meant that Fidelity was sued by its employees and had to settle and say, yeah, we should have been offering Vanguard products to our employees.
Unbelievable. Unbelievable.
We've got another, that is truly something. So another question from the Q&A. You may have already addressed this, but how do you think about the psychology of the remaining active managers? You estimate that passive is around 50% or heading to 50%, give or take. But what about the active managers who buy indexes to keep their jobs? Said another way, how do you think about the psychology behavior of remaining active that could be characterized as passive? Yeah, that levered beta, essentially.
Yeah, I think the questioner answered their own question, right? In order to survive, you are increasingly forced into strategies that mimic the indices, right? Or even in more perverse form, access the indices in levered form, right? And as a result, that doom loop is accelerated and operates in an exponential framework. I'll give people just a really simple example. I skipped the slide that walks through the cash dynamics. You know, the horrifying story that I like to point out to people is that, you know, you'll see Michael Hartnett, for example, at B of A with his flow show. You know, he'll do a survey where he'll say, you know, what are current cash levels, right? What are cash levels of funds invested in the market? And one of the pushbacks that I've had from Michael for years has been, well, that's fantastic, except for the fact that Vanguard doesn't respond to your surveys, right? So when you tell me the cash level, what you're telling me is the cash level of active managers. And yes, there's some value associated with that, but the reality is that increasingly we're moving to a world in which there is less and less cash being held in the fund structures. The world's largest mutual fund complex is the Vanguard Total Market Index, right? Both the ETF, VTI, combined with VTS MX and its related components. It's about $1.6, $1.7 trillion in total assets, right? The average active manager carries somewhere between 3 and 5% cash. That's where those numbers came from in my analysis. That would imply that Vanguard has to be holding somewhere in the neighborhood of $50 billion worth of cash in the Vanguard Total Market Index. They're currently holding 120 million. Right? At one point last year, they had negative cash. They actually tapped a line of credit, right? What that means is that the remaining active managers have to carry all the cash if the market is going to be able to respond, and they can't do that, right? That's a death sentence for themselves. So you end up in this really messed up situation where in order to survive, everybody is engaged in mutual self-destruction.
We've got another one from the Q&A. Is there a sense for level of passive penetration flow in stock by investor type, institution, retail, et cetera? Does this have additional implications or does it not ultimately matter?
I'm sorry, give me 1 second here. Yes, so I just want to make sure that I read the question properly. So again, the Marco Salmon piece talks about the aggregate market. If we look at the underlying dynamics on the retail side, again, it's very much split demographics. In aggregate, between ETFs and mutual fund, the split appears to be about 57% passive and about 43% active at this point, passive gaining very rapidly in that space. The extreme version of that, Eric Balkunas at Bloomberg, who is their ETF strategist, has the basic view that the market is going to consolidate to 3 players providing beta, Vanguard, BlackRock, and to a certain extent State Street, possibly Invesco, and then a whole bunch of other people doing wild and wacky Cathie Wood type stuff to give people some excitement, right? I think that's a terrifying vision of the future. It could be right, but it's not a sustainable one, right? That degree of concentration is really painful. On the institutional side, there's even higher penetration, right? So again, it's important to remember that the passive revolution was actually kicked off by Wells Fargo going after institutional accounts. Most estimates that I see suggest that institutional investors have about 70% allocated to passive within their public equity framework. This would be, something as simple as CalPERS, for example, choosing cheap beta. And they do this for very, very obvious reasons. The remaining portion largely falls into the quote unquote unmanaged. So about 30% of the market is unmanaged is the way to think about it. And that can be individual holders as a family, et cetera. And that is obviously overwhelmingly active in its underlying construction. Right, not particularly active in its trading, but certainly active in terms of its management dynamics.
And that's the source of in the nightmare scenario of the redemption, sell out, take your ball and go home.
My nightmare scenario is simply retirements ultimately start taking more money out than they're contributing, and they begin to do so by selling the indices rather than selling value stocks, for example.
Gotcha. And so we've got another question. How has this thesis? This is something that we talked about in our prep for this webinar. How has this thesis been received by policymakers? Has Mike presented this in the past? Has he made any penetration with policymakers? Are there any other voices, any others voicing these concerns to policymakers? Will it ever be possible to outpunch the vanguard lobbyists absent a cataclysmic event that Mike has detailed? Someone who knows the landscape in Washington, D.C. asking this question.
Well, so they really hit on the critical component. So I first started presenting this to policymakers in 2017. My favorite response was the IMS Financial Stability Group, the old Claudio Borio group, where they met with me, they walked through the analysis, they came back and they said, you know what, we actually agree with you. We think your analysis is correct. And I said, oh my God, that's fantastic. All right, so what are we going to do about it? Well, there's nothing we can do. And I said, what do you mean? And they said, well, you don't understand. Vanguard controls the regulatory apparatus, Vanguard and BlackRock, to be fair. And they're correct. Vanguard and BlackRock spend more on lobbying than the rest of the industry combined, and they dominate the Investment Company Institute, which in turn is actually lobbying on their behalf as well, rather than the industry in total. Look, Mike Green says something credible, shows some pretty graphs, may have a trade or two that have worked out. And so, I'll say these things, and the obvious immediate next phone call is to Vanguard to say, hey, this is the disturbing story I've heard. And the response to that is very simply, oh, that's just another aggrieved active manager that can't beat the S&P 500, trying to explain why he sucks at his job and why he can't collect assets, right? That very well may be true. Maybe I am an aggrieved active manager who beat the S&P 500, right? But that's not really the motivation behind what I'm doing. The point is that I'm trying to share this. Now, we're starting to see some elements of breakthrough, and interestingly enough, they're coming on both sides of the aisle. I would argue that Larry Fink made a very important tactical error when he began pursuing ESG, because it opened up the risks of ESG style frameworks. I think he looked at it as a way to increase the margins for BlackRock. I don't think he realized that it was going to piss off Alaska and Texas. And so senators from both of those regions have introduced legislation, the Index Fund Act at the national level, and then Texas with disinvestment from BlackRock, among other things, where they basically have said, look, these investors are hostile to the interests of our state, right? That's being matched by some interest coming from the Democrats, where they are increasingly growing concern about the monopolistic tendencies of these businesses. And I'll just give a really simple example that I already mentioned. That type of bundling agreement between our service provider and Vanguard is largely illegal under antitrust law. That's not stopping it. It's underway, and it all becomes a question of, is it actually prosecuted? And so we're seeing concerns from the ESG side, primarily on the Republican front, and on the market concentration side from the Democrat front. It is starting to change, but this is understand, this is the Titanic that we're trying, this is a giant ship we're trying to turn around, and explaining to the American public why we're taking away their beloved index funds is almost certainly going to be much more challenging than simply, getting them on an hour-long Zoom call in which I walk them through all the slides that explain why they should be paying premium fees to active managers, right?
Well, Michael, I assume that this has got to be the largest financial trend that the government would be involved in. So yes, it makes sense that it's going to be you call it a tanker. It's probably bigger. Well, than that.
Yeah, so listen, I've spoken very publicly about this, and it's the core of my concerns, right? It's completely asinine that we as a society have decided to outsource our retirement system to the public markets, right? That's what we've done. We took the responsibilities associated with defined benefit plans in which long-term corporate employers or the government guaranteed certain outcomes, and we converted that into, well, we're going to rely on the market to do that, and your skill as an individual investor. That becomes a societal catastrophe if we discover that the process of doing that has actually perverted the markets themselves, right? The markets were not designed to provide retirement to Americans or Europeans or anyone else for that matter. They were designed to allocate capital as efficiently as possible, and we've now corrupted both aspects of it.
Another question from the Q&A. Why isn't this the golden age of active management, not the hedge fund equity renter, but the long-term equity owner buying partial stakes in companies and selling for materially less than intrinsic value?
Well, not and selling for materially less than intrinsic value. So I would argue that actually is a very accurate description of what we've experienced, right? I mean, we have gone through a period of multiple expansion that has ridiculously enriched those who have purchased along the way. The question is that happening because we're more efficiently allocating capital today? And the behavior of stocks like AMC, GameStop, or even for that matter, the largest stocks in the market, Apple, et cetera, would suggest that's just not true. Right? Like, understand that we have a theory of how markets work called the efficient market hypothesis. And the hypothesis is that the competition to allocate capital means that the market price is the best reflection of all available news. Right. If the dominant participant in that market becomes a player who doesn't use information at all other than the current price of the security, why would we think that continues to be true? And, again, I talk about the academic explosion, right? Almost a Precambrian explosion of innovation that began to occur in 2020. The seminal paper that kicks that off, and in my view is going to be a front runner for the Nobel Prize at some point in the future, is Xavier Gabay at Harvard and Ralph Koyagin at University of Chicago wrote a paper called The Inefficient Market, or the Inelastic Market Hypothesis, that came out, I believe, in I think it was April of 2020. It could have been August 2020 now that I just said that. And one of the things that they looked at is the impact of flows on market cap, right? So the traditional specification of the efficient market hypothesis is that there's not that much impact from market players entering or exiting the market. And you can kind of understand why that is because, John, you buy a share from me, your cash levels go down, my cash levels go up. There's no real change in cash in the system. Therefore, by definition, there can't be that much of a change, right? The actual number, the assumed dynamic in most iterations of the efficient market hypothesis are that a dollar going into the market causes about a 1 penny increase in market capitalization, right? Gabay and Koyagin's work suggests that number is actually $5, right? So in other words, a 500x multiple of the inelasticity of what we had under the efficient market hypothesis. If that is remotely correct, then the efficient market hypothesis needs to be thrown on the ash heap of history, right? And the systems that we're deploying simply don't work under that framework, right? The penalty associated with using tools like passive investing is simply too high. We need to figure out ways of taxing it to reflect those dynamics, and putting limitations on its growth, right? We're still a long way away from that. And it's basically, on my analysis, a race to do we get to the catastrophic event before we get to the realization that we have to change things.
Well, I realize
we can't know that.
Yeah, we're at the hour. This is a fantastic set of questions. I apologize for not being able to get to them all. We'll endeavor to do so over email. And if you have a question that hasn't been answered, please drop us a line at Markets Policy Partners. You can find us on the web at marketspolicy.com and our contact information there. We will endeavor to get back to you on the questions unanswered. Want to have a great big thank you for Michael Green. This is incredibly insightful and as I said, sobering discourse on passive investing, which is seen in the mainstream as just a the most easy and benign kind of dynamic in markets, and very well could be anything but. So thank you all very much for joining.
My pleasure. Thanks a lot, guys.
Thanks, everyone.